Welcome back to Zodiac Trading. In this episode, we talk about almost everything about finance. And in this episode, we will talk about Silicon Valley, which is the ticker SVB, which is a very significant bank located in US, California. And uh, currently, the SVB is suffering some of the major crises. And because SVB has basically gone insolvent and it was bankrupt because of its depositors were quickly cashing their savings and all of their money out of the bank. So meaning SVB SVB was bankrupt because of the bank run. So this is precisely what happened with SVB. So the first thing that really happened with SVB is um, its management board had a very bad judgment of the macro environment. So they end up buying lots of bonds. They buy lots of mortgage-backed securities and other fixed income products. But the fact that you have rising inflation and that kind of inflation would be toxic for bonds. So basically, you will have rising bond yield, and then you also have decreasing bond prices, meaning that you will be losing money buying all these bonds. So SVB was making a very bad investing decision, and it was not making money out of bonds. It was basically losing money out of bonds. So, and its investors were panicking because of the fact that SVB is suffering some of the major losses when buying bonds. So there'll be rumors spreading around its depositors. That's the first thing that is really happening. So the second thing is that um, if you take a look at the SVB's business model, it's a it's what it's not exactly a commercial bank. SVB provides a series of different long packages for we're calling these startup companies. SVB is providing a variety of different packages and loans to different, we call this unicorn or these small companies, small startup companies. Some of them are big companies. You're providing them with very flexible loans, and they are making interest rate as payment out of it. Their profit comes from basically lending out money, and also they are making money out of investing in the fixed income market because the fact that during the QE era they'll be able to get and raise capital in very low interest rate. That means the the cost of their capital is extremely low because during the QE era you have very low costs. You're nearly zero out of that cost, and you'll be making if you simply use that money to buy bonds or fixed income products, you'll be making good amount of money, like typically 3 to 4% and somewhere like that. And that for a lot of investors in Silicon Valley, that is a juicy return. So there are tons of depositors of SVB putting their trust and their money inside of SVB because most of the clients of SVB are actually institutions, and we're talking about VC venture capitalists. We're talking about internet companies. They have tons of cash. They don't know what to do with it. They simply put this money inside of Silicon Valley Bank. And the third thing is because right now we are facing a rising inflation and also the fact that the Fed decides to raise interest rate very aggressively. So it turns out right now we are having nearly 5% of inflation, no, nearly 5% of interest rate. And that really kind of hurt the bank. Banks are having to suffer and pay more of their cost because right now the banks have to pay depositors interest rate, so these depositors could continue to deposit your money in a bank. So a lot of investors, and a lot of venture capitalists, they are having increasingly less of the capital. A lot of their investors are withdrawing the money, and a lot of these depositors are moving their savings from SVB to other traditional commercial banks. So put yourself in VC shoes. You'll be able to get a better picture of it. So if you're a venture capitalist and you realize it's difficult, extremely difficult, um, to build a high growth, some sort of unicorn kind of company during these kind of periods. So you reckon it would be nice for you um, to just move your savings from SVB and then put it somewhere else and to receive increasingly higher interest rate so you can get more money out of, simply save your money inside the banking system. So that is the reason why Silicon Valley Bank, the SVB, has a decreasing amount of depositors. And unfortunately, the depositors, in SVB's case, they're quite concentrated. That means you have when investors get panicked, when they get like bank run, they almost, get out together. So this is what actually happens. So it's not like the traditional commercial bank because comparatively speaking, in the traditional commercial banks, you have smaller individual depositors. They're, they probably takes movements a lot slower, and they are not as keen as all these VC and all these institutional investors like SVB's clients. So it turns out the rumor spread that they are making losses and it's CEO dumping shares. Before that, they have done pretty bad, pretty wacky job when it comes to hacking and hedging the interest rate. So they have suffered losses. So that's why a lot of VCs and their depositors are withdrawing their money as quickly as they can. And then that rumor turns out, and in very short period of time, 48 hours, the SVB has gone from, rumor from bankrupt. And the third thing about SVB is the fact that SVB has gone and got be wiped out so easily is because the mismanagement of the SVB, because they're trying to raise money out of, they're trying to add shares, they're trying to use their shares, collateralize their shares to finance for more money to compensate what they have lost in the fixed income positions. For them, for that, I don't think they're being responsible for their depositors. And then the fact that the senior management were selling shares not very long ago. We're talking about days before these crises happened. That actually demonstrate a series of inside job, a very very serious of uh, the moral conflicts, because your bank manager sells all of his shares trying to escape from what's going to come. They knew this is going to come. Okay, so what happened now is Silicon Valley Bank got sort of bailed out. The fact that it got bailed out is because the Federal Reserve decided, and also the FDIC took over the Silicon Valley Bank, and they are having to release this joint statement out of the Treasury, also the Federal Reserve, and also the FDIC. So FDIC it's a government department that was built to protect this sort of event, to protect the depositors from the failure of the banks. So the FDIC is so-called the Federal Deposit Insurance Corporations. is providing up to $250,000 to ensure depositors' money wouldn't just be wiped out just like that. And they claim that they're going to help restructure the Silicon Valley Bank. They're trying to um, give a very strong confidence to these depositors that their money would not be lost. Uh, the FDIC is going to compensate their money out of the system. Okay, so where does the FDIC get the money from? There are a lot of premier banks members are paying like annual membership fee, something like that, to the FDIC. So we're actually withdrawing that amount of money. We're talking about around $25 billion, around like that, of credit protection out of FDIC provided via the membership. All these banks, they are giving money to the FDIC. So the FDIC is basically using the bank's money to bail out the depositors. And we are not very clear of what's happening to the Silicon Valley senior management ship. Like, we don't really know what's happening to them right now. But I'm trying to figure out what's going to happen to this management. What would be the punishments for this mismanagement? Because if the Federal Reserve and the Treasury would bail out these mismanagement so easily, that would only encourage banks to take more risk in the future. But we're still having these inflation problems, so it is not difficult to reckon that inflation will just continue to rise. So in that situation, probably more banks going to take more risk, and most of them, I highly suspect, they are not going to get any hedges out of interest rate, and so the similar situation would happen. So what would be, I mean, if that happens, what is FDIC gonna do, right? Is it simply going to bail out all the banks depositors, or is it going to let the mismanagement board to be bailed out? Okay, and I've seen many people claiming that this is the right thing to do to bail out depositors' money, but I have, for example, Bill Ackman been saying it's just the right thing that the U.S. is bailing out its depositors. And for that, I will make another video to explain why it is very risky for FDIC to compensate for the losses of the depositors, and what that is going to create. And a lot of financial experts would claim that this is not a bailout. But I would argue this is a bailout, but it's just a very kind of twisted, and it is a very shady and sneaky bailout. So thank you guys for watching. Today we talked about a little bit of how Silicon Valley actually work, and how did the Silicon Valley Bank actually collapse in just 48 hours. So if you guys like my content, please click that like button for me, and I will see you in the next episode. See you. Bye.